Last year, I sat down with a physician in her early 50s. She had nearly $2 million dollars invested, a great CPA, and a financial advisor she'd worked with for years. She later discovered there were tax planning opportunities that had not previously been considered. Not because of anything exotic and not because of anything her advisor or CPA had done wrong, but because three specific strategies that are completely legal, written into the tax code, available to anyone, had simply never been explained to her. That happens more than you'd think. If you have a 401k, a brokerage account, and investments that have grown over time, there's a real chance it's happening to you too. Stick around. By the end of this video, you'll understand exactly what those three strategies are, and more importantly, whether anyone in your financial life is actually using them. By the way, if by the end of this video, you're wondering whether any of this is actually happening in your financial life, there's a link below to schedule a call directly with me. No cost, no sales pitch, just a straightforward conversation. All right, let's get into it. I'm Matt Tuft. I'm a CFP, which is a certified financial planner at 40 North Wealth. I'm based in Denver and I work with clients all over the country, and I work with people going through significant financial transitions. They're approaching retirement, they have a business sale, an inheritance, or just reaching a point where they've built real wealth and want to make sure they're not giving more of it to the IRS than they have to. In over 25 years in this business, the thing that never stops surprising me is how many sharp, high-earning people are missing the strategies we're about to cover. Not because they're complicated, but because nobody ever sat down and connected the dots. So let's fix that. All right, let's start with strategy number one. Strategy number one is called asset location. And I want to be clear, this is very different from asset allocation. Here's the core idea. Where you hold an investment matters almost as much as what you hold. You probably have money in a few different buckets, a 401k, an IRA, maybe a taxable brokerage account, and maybe a Roth. Every dollar in those accounts is invested, but the IRS treats the gains in each one completely differently. Investments that throw off a lot of taxable income, such as bond funds, REITs, actively managed funds with high turnover, those should generally live in your tax-deferred accounts, like your IRA or your 401k. That income gets sheltered. You don't owe taxes on it until you pull the money out in retirement. Meanwhile, tax-efficient investments, such as broad index funds, ETFs that don't generate much in the way of dividends or distributions, maybe individual stocks, those can sit in your taxable account without creating much drag. Growth-oriented assets, on the other hand, are often best considered for Roth accounts. When that account grows, you'll get all of those growth out of it tax-free. A few years back, I worked with a physician. He was in his early 50s, doing well, and had a solid portfolio. He came to me with essentially the same investments in every single account. Same funds, same allocation everywhere. He'd never really thought about where things lived, which tax bucket they were in. By repositioning investments among his existing accounts, we were able to improve the tax efficiency of his portfolio and reduce his annual tax drag by thousands of dollars a year, every year. Asset location isn't exciting. Nobody puts it on a magazine cover. But when implemented correctly, these strategies can be effective tools for reducing taxes, but their success depends on your individual circumstances and proper execution. All right, strategy number two is tax loss harvesting. And this is what sounds counterintuitive at first. After all, in order to harvest losses, you have to have losses. And why would you want that? Well, here's the core idea. At any given point throughout the year, some of your investments may be down. As we know, investments rarely grow in a straight line. So when one of your investments is down, you can sell it, lock in that loss on paper, and use that loss to offset gains you've made elsewhere in your portfolio. The IRS lets you use investment losses to cancel out your investment gains. And if your losses exceed your gains in a given year, you can use up to $3,000 of that excess to offset ordinary income. Now, anything beyond that carries forward into future years where it keeps working for you. Now, I know what you're thinking. But Matt, if I sell a losing investment, don't I miss the recovery? It's a fair question. Their answer is you immediately reinvest those proceeds into something similar, not identical, to keep your market exposure intact. You stay invested, you just captured a tax benefit along the way. Now, there's one rule you have to know: the wash sale rule. The IRS says you can't sell at a loss and buy the same investment back within 30 days. If you do, the loss is disallowed. But buying something similar, like selling one S&P 500 index fund and buying a slightly different one, that's perfectly fine. I want to take a quick pause here. If you're already thinking, I don't know whether my advisor is doing any of this, that's exactly what a second opinion conversation is for. Click the link in the description and we can talk more about it one-on-one. Now, back to why this one matters so much for serious investors. Here's what makes this a wealth building strategy and not just a cost cutting one. Wealthy investors have large taxable accounts, more positions, and more opportunities for gains and losses to interact throughout the year. The tax savings compounds alongside the returns. Most people only think about taxes in April. Wealthy investors and their advisors are harvesting losses in October, November, and December. It's a year-round discipline, not an annual scramble. I'll be direct with you. If you've never had a specific conversation with your financial advisor about tax loss harvesting in the fall, not just at tax time, it's probably not happening. Most advisors focus on the financial plan. Few are actively watching the portfolio for tax opportunities throughout the year. That gap is where a lot of money quietly leaves. Okay, strategy number 3. This is an often overlooked tax planning strategy in all of personal finance because many financial advisors don't coordinate your investment strategies with your estate plan. The strategy is called the step up in basis. Here's how it works. When you buy a stock or a fund, you paid a certain price. That's your cost basis. When you sell it, you owe capital gains taxes on the difference between what you paid and what it's worth when you sell. But here's where most people don't know. When you pass an appreciated asset to an heir, the cost basis resets to the value at the date of your death. Think about what that means. If you bought Apple in 1995, your cost basis might be a few dollars a share. It's worth hundreds of shares today. If you sell it, you owe capital gains taxes on almost the entire amount. But if you hold it until death and leave it to your kids, they inherit it at today's value. Then if they sell it the next day, that's decades of gains legally wiped clean. Now, I want to be thoughtful here. I'm not suggesting you structure your entire financial life around avoiding a tax your heirs might eventually pay. That's letting the tax tail wag the dog, and it's bad planning. But being aware of which assets you're sitting on that have large unrealized gains and being deliberate about which ones you spend down in retirement versus which ones you hold and eventually pass on, that's just smart planning. This is also where your investment strategy and your estate plan have to talk to each other. Which bucket do you draw from first in retirement, or which assets do you leave? The step up in basis is one of the factors that should shape that answer. This is not a loophole. It's been in the tax code for decades, and it's available to anyone who has assets that have appreciated, which if you've been investing for more than 10 years, likely includes you. If you have appreciated investments and haven't had a specific conversation about which ones to hold versus which ones to spend, that's a gap worth closing. And it's exactly the kind of conversation I have with clients all the time. Link below to schedule time with me directly. All right, let's bring this all together. There's 3 strategies. They're all legal, all available right now. First, as we said, is asset location. Put the right investments in the right accounts. Tax loss harvesting. Turn your losers into tax advantage year round. And step up in basis. Hold appreciated assets strategically, especially what you leave behind. None of these are complicated in concept, but they require coordination between your investments, your tax situation, and your long-term plan, which is exactly why most people don't have them in place. There's nobody connecting those dots for them. If you're watching this and you're unsure whether any of these strategies have been evaluated for your specific situation, it may be worthwhile to discuss them with your financial professionals. Use the link below to schedule a 30-minute call with me. There won't be any sales pitch, there's no obligation. It's just a straightforward conversation about whether any of this applies to your situation and what it might be worth to fix it. And if this is useful, subscribe. I put out practical financial content every week for people who are serious about building real lasting wealth. Thanks, and see you in the next one.